Here's part 2 of our 12 tips how to reduce your taxable income. We're going over the final 6 tips today. So last week we talked about reducing your taxable income. We went over 6 tips how to do that. Please check out that prior video. We're going to go over the second half, the second 6 tips today, how to reduce your taxable income. And we're going to start number 1 with today, which is number 7 on the list, Roth conversions. The maximum contribution we can get to max out this tax bracket. Maybe we're trying to max out only the 12% bracket or the 24%. The key is do it enough to when you're 72, that's the RMD age. When you're 72 and older, that now that maybe you have all your IRAs converted over to Roth. So you don't have to count that as income. When you take money out of your Roth account to live, that's not taxable income anymore. And then when we look at only Social Security, well, maybe it's all taxed. Maybe it's all tax-free, or maybe it's only partially taxed. So the key is doing Roth conversions to reduce your future taxable income. I have several clients that have done enough Roth conversions. When they're 72, none of their Social Security will be taxed on the federal level. And if you're in one of those 12 states, it all depends if it'll be taxed on the state level. But if you have no federal taxes, you're not going to pay any state taxes there anyways, even if you're in one of those 12 states. Another quick note on this before we move on. If you're 72 and older, can you still do Roth conversions? The answer is yes. But you have to take out your RMDs first. If you have monies that you have to take out, you require minimum distributions. You take out your RMDs first that year, and then you can do Roth conversions, so you can continue to keep doing them later on. There's no limits on conversions. It's not like a contribution. There's no limits how much you can convert as long as you're willing to pay the taxes on that money. Tip number 8, donor advised funds. Now, we're going to put a little Investopedia. I think they do a good job explaining this, a little synopsis of what a donor advised funds is. But there's one way that you can reduce your taxable income up to 60% if you're going to donate money, cash, to give for future charity. If you're donating your maybe stock or securities, 30% you could take off your adjusted gross income. So as we put this Investopedia little chart up on here, it's great for people who want to give away. So if you have a lot of appreciated assets and you don't think you're going to need this money for retirement, what do? There's one way that you can actually donate into put this money in trust, and you can take that immediate tax deduction. So read up on this Investopedia synopsis, paraphrasing this, up here on the site. You might want to pause the video and just look it over here. Number 9, which is tip number 3 of the second part, is capital losses. So if you have non-qualified retirement assets, we're not talking about Roth money, we're not talking about traditional IRA money, we're talking about non-qualified money that's not part of that group, where you're investing maybe some money in stock or some other investments like that. And if you sell say a stock at a loss, you can deduct up to $3,000 on your taxes as a capital loss. So let's just say you had $150,000 of cost basis, which means that's what you invested in it, and you sold it at $120,000. So you took a $30,000 loss, which is not great, but maybe you were forced to do that, maybe for an income need or emergency came up. Well, you took a $30,000 loss. You cannot take that whole $30,000 right off on your taxes. You can take only a maximum of $3,000 per year. So you can carry that over each year. So that is going to be 10 years. You can write that $30,000 off. There is a wash rule when it comes to that, though. So you cannot rebuy that stock for after 30 days later. 31 days is when you can repurchase that same stock. So if you sold something at a loss and 20 days later it was a good buy, you bought it back in, you don't get to write off that. You have to wait over at least 30 days so you can buy it on that 31st day. It's called a wash rule. Tip number 10, 4th out of the 6 here, is donating to charity. That's always a great way to take a tax deduction. But we're finding a lot of people who donate to charity, they don't get that big tax deduction because if you're not itemizing your taxes, you don't get those, those donations if you're a big giver to a charity or a church or whatever it might be. So if you're not itemizing, the maximum you can deduct without itemizing by giving to charity is $300 for a single, $600 for a couple who file jointly. Now, if you're itemizing, you get that full deduction of what you give. So we get some big givers can write that off. You can write off up to 60% of your income if you're donating that to charity. One other quick tip on this is if you are giving money away, donation, you need a receipt if it's at least $250 or above. So you need a receipt from whatever that charity it is if it's at least $250 or higher. Tip number 5, which is number 11 of this 12 tips, is delay Social Security. By delaying Social Security, how's that going to save in taxes? Is because we know what your benefit does. We do probably a good 500 Social Security reports a year in this office, helping people maximize and understand their benefits. But what happens is your benefit is growing each month. It doesn't just grow each year, it grows each month. That's a fixed amount plus the cost of living adjustment, which of course was great for this year, 5.9. We don't know what that'll be for 2023. But we know your benefit is growing each month and each year, of course. So by delaying Social Security, we know that your benefits can be so much higher, you'll need less money from your investments. Let's just say you need $6,000 a month, but if you file Social Security early, you're going to need a lot more money from your IRAs or 401ks, right? Which those are all taxable. But if you delay Social Security, and of course if you're working or if you use up more of your investment money early on to let Social Security delay, now your benefit is so much bigger. We know your benefit from 62 till 70 will be about double. It doesn't show that on your statements, but it actually will with the cost of living adjustment that is averaging about 2%. So if your money is going to be double, that means at 70, just say your benefit is $3,500 a month instead of $1,750 at 70, and maybe if you're married, that's additional Social Security as well. You need less money from your investments to make ends meet. Then the other part of it, there's a provisional income formula that we talked about before. Not all of Social Security is taxed. There's a lot of people, like I mentioned in one of the earlier tips, if they're delaying Social Security, they're not paying any taxes on their Social Security because only half of that is considered income for this formula, and you might be in a really good spot to pay taxes a little bit earlier to delay it later. Just like Roth Conversions, you have to look at long-term for this. Any questions, just send us a message and we can help you explain and understand, or check out one of our previous episodes here on Social Security. And the last tip here, kind of a lead to this, the one we're going to do next week, is move to a tax-friendly state. I'm not saying that everybody should move to save money in taxes, but there are a lot of our clients who are interested in keeping more money in their pocket. Of course, the most popular one is Florida. Florida is a zero state tax bracket. Showed before where we have clients that are moving down there, they're saving $800, $900 a month in just state taxes, just by moving to a state like that. So there's other states that are tax friendly. There's Tennessee, we look at these southern states are pretty friendly. Arizona's not bad, but other states are very tax friendly in retirement. That's something to consider. And sometimes for people who want to live that life, you want to maintain that lifestyle, sometimes that's almost necessary. We've shown people before they're going to run out of money living in the Midwest. They move to a tax-friendly state, and now they don't run out of money. So it's all about fitting that in your plan. So I'm leading this up to next week. Next week we are heading on a spring break trip, and we're going to do a YouTube video there talking about what are the tax-friendly states to retire in, the most tax-friendly states to live in. So please click that like button. We really appreciate it. We appreciate all the new subscribers that are coming on daily, and we're going to get you some more great information here, especially next week on those tax-friendly states.